While most people panic during an oil crisis, smart investors quietly position themselves to build massive wealth. How do global conflicts like the Iran-Israel tensions impact oil prices, markets, and investment opportunities? And why do some people come out of crises richer than ever? In this video, I'll break down the key lessons from How to Get Millionaire During Oil Crisis, including the industries, assets, and financial strategies that historically perform during energy and market disruptions. Watching fuel prices rise and markets become unstable can feel scary and confusing. Most people freeze during uncertainty, but financial history shows that crises often create opportunities for prepared investors. By the end, you'll understand how oil crises affect the global economy, what smart investors focus on during uncertain times, and how to think strategically instead of emotionally when markets become volatile. The first millionaire of the oil crisis did not discover oil. He discovered fear. That's the part most people misunderstand about financial disasters. Fortunes are rarely built by the event itself. They are built by recognizing how humanity reacts to the event before everyone else does. And in 2026, fear moved faster than oil. The morning the Iran-Israel war officially escalated into direct military confrontation, most Americans were still asleep. But inside New York trading floors, Houston energy offices, and Washington intelligence rooms, the atmosphere already felt electric. Screens glowed red, phones rang endlessly, commodity traders stopped joking. Because everyone understood what the average citizen did not yet realize. The world's energy system was about to enter shock. At exactly 4:12 a.m. Eastern Time, Brent crude futures surged violently after reports emerged of severe military escalation near the Strait of Hormuz, the narrow waterway responsible for transporting nearly 20% of global oil supply. Analysts immediately warned that even temporary disruption there could trigger a historic energy crisis. Within hours, America woke up to a different financial reality. Oil prices climbed aggressively. Stock markets swung wildly. Energy companies surged upward. And suddenly, everyone wanted to understand the same question. Who gets rich during an oil crisis? Because somebody always does. Always. The average person sees chaos during energy shocks. Smart investors see transfer. Wealth does not disappear during crises. It moves fast, violently, and usually toward the people who understand systems better than emotions. That's why the oil crisis millionaires of 2026 were not random gamblers. They were observers, predictors, people who understood one brutal truth about the modern economy. Everything depends on energy. Food depends on energy. Transportation depends on energy. Military power depends on energy. Global trade depends on energy. And when energy becomes unstable, money flows toward whoever controls stability. An old Wall Street saying suddenly became famous again during the crisis. When the world panics, buy what the world cannot survive without. In 2026, that answer was obvious. Oil, natural gas, shipping infrastructure, defense systems, energy logistics. The smart money moved immediately. Before television anchors began discussing shortages, hedge funds increased exposure to energy companies. Before social media panicked about fuel prices, commodity traders positioned themselves for prolonged volatility. Before average citizens even understood where the Strait of Hormuz was located on a map, billion-dollar investment firms had already recalculated the future. That's how wealth works during geopolitical crises. Speed matters more than intelligence. The people who hesitate financially during energy shocks usually become victims of inflation. The people who move early often become beneficiaries of instability. A famous energy investor once said something deeply uncomfortable during a CNBC interview. The public reacts emotionally to oil shocks. Professionals react mathematically. Mathematically. That single word explains why some people become rich during crises, while others collapsed beneath them. Because the oil market is not emotional, it is mechanical. If supply falls while demand remains high, prices surge. If shipping routes become dangerous, transportation costs explode. If energy prices rise, inflation spreads everywhere. And whoever predicts these chains early enough positions themselves ahead of the panic. The United States became the center of this financial transformation almost immediately, not because America suffered the most physically from the conflict, but because America controlled the world's largest capital markets. Wall Street transformed geopolitical tension into financial movement at astonishing speed. Oil companies gained billions in valuation within days. Defense contractors surged sharply. Shipping firms tied to alternative energy routes exploded upward. Meanwhile, airline stocks weakened. Retail companies struggled. Transportation-heavy businesses suffered immediately. The market was announcing the winners and losers before politicians even addressed the nation publicly. And smart investors listened carefully. One 29-year-old trader from Texas reportedly turned a $200,000 position in oil futures into almost $18 million during the first month of the crisis. Not because he was lucky, because he understood history. Every major oil disruption in modern history created the same pattern. Energy prices surge, inflation spreads, governments panic, markets overreact, and fortunes are built during the confusion. The 1973 oil embargo created energy dynasties. The Gulf War created commodity fortunes. The 2008 oil spike reshaped global wealth. Now the Iran-Israel conflict was doing it again, only faster, much faster. Because by 2026, financial systems had evolved into high-speed emotional machines. Algorithms traded headlines before humans fully processed them. Artificial intelligence scanned military statements, shipping data, and satellite images in real time. Fear itself had become tradable. A missile strike overseas could now create billion-dollar market reactions before ordinary Americans finish breakfast. And this is where the first lesson of becoming wealthy during an oil crisis begins. The biggest fortunes are not made by following headlines. They are made by understanding consequences before headlines appear. Most people looked at the Iran-Israel war and saw military conflict. Professional investors saw supply disruption, inflation, transportation stress, commodity shortages, defense expansion, energy scarcity. Secondary effects create the real money. That's the hidden architecture of crisis investing. A single disruption in oil supply affects thousands of industries simultaneously. Trucking costs rise, airline costs rise, manufacturing costs rise, agricultural costs rise, electricity prices rise. Everything connected to movement becomes vulnerable, and everything connected to energy becomes powerful. That's why oil crises create millionaires so quickly, because modern civilization is unbelievably dependent on stable energy flow. When that flow weakens, entire sectors of the economy begin transferring wealth toward whoever controls or predicts energy markets correctly. The International Energy Agency later described the situation as the greatest global energy security challenge in history. Commercial oil inventories depleted rapidly, while strategic reserves were used aggressively to stabilize markets. But by the time governments acknowledged the seriousness publicly, early investors had already positioned themselves. That's another painful truth about markets. The public usually enters crises late and exits late, which means the public often absorbs losses while institutions absorb opportunity. One retired hedge fund manager explained it perfectly during a podcast interview watched by millions. The first phase of every crisis creates fear. The second phase creates billionaires. America entered the second phase very quickly. Texas oil executives suddenly became national celebrities. Energy analysts appeared nightly on television. Wall Street banks released emergency reports predicting prolonged volatility. Some forecasts warned that if shipping disruptions intensified, oil prices could reach levels unseen in modern history. And as prices climbed, ordinary Americans started feeling pressure everywhere. Gasoline became expensive, food prices climbed, travel costs surged, inflation spread rapidly through the economy. Analysts warned that rising fuel costs could significantly impact household budgets and consumer confidence across the United States. But while average families worried about survival, the oil crisis millionaires focused on positioning, because they understood the most important lesson of all. Oil crises do not merely destroy wealth, they redirect it. Most people think millionaires are created by intelligence. During crises, that is only partially true. The real advantage comes from emotional control, because when fear enters markets, the average person stops thinking strategically. Human beings become reactive during uncertainty. They search for safety, certainty, and reassurance. Meanwhile, experienced investors search for asymmetry. That single difference changes everything. By the second month of the Iran-Israel war, panic had spread far beyond energy markets. Americans watched fuel prices climb almost daily. Airlines increased fares aggressively. Grocery costs surged due to transportation pressure. Social media amplified every rumor about shortages, refinery attacks, and military escalation. The atmosphere felt unstable, and instability creates irrational behavior. That's where oil crisis millionaires begin separating themselves from the public. Not because they predict every event perfectly, because they understand how crowds behave under stress. A famous investor once said something during the 2008 financial collapse that became legendary again in 2026. The crowd buys comfort at the top and sells fear at the bottom. That sentence perfectly described what happened during the oil crisis. Ordinary investors panicked as inflation spread. Many sold positions emotionally after watching markets swing violently. News channels amplified fear constantly because fear attracts attention. But professional commodity traders viewed panic differently. They treated fear as data. When average citizens stopped flying due to rising costs, they studied airline exposure. When trucking companies struggled with fuel prices, they analyzed logistics chains. When governments discussed strategic oil reserve releases, they examined long-term supply deficits. Every public panic revealed hidden opportunities. That's the second lesson of becoming wealthy during an oil crisis. The biggest money is rarely made from the obvious trade. It's made from secondary consequences. Anyone could see oil prices rising, but smarter investors ask deeper questions. Which industries benefit from expensive oil? Which industries collapse? Which governments panic first? Which companies become strategically essential? And most importantly, what changes permanently after the crisis begins? That final question creates enormous wealth, because true fortunes are built by recognizing structural transformation before society accepts it fully. In 2026, the smartest investors realized something early. The world was not entering a temporary oil spike. It was entering an era of energy insecurity. That distinction mattered enormously. Temporary spikes create short-term trades. Structural instability creates generational wealth. And America became the perfect environment for this transformation because U.S. financial markets react faster than any markets on Earth. Wall Street absorbed geopolitical tension instantly and converted it into price movement. Energy infrastructure firms exploded upward. Pipeline companies surged. Defense contractors tied to Middle Eastern operations rallied hard. Cybersecurity firms protecting energy grids gained billions in valuation. Even railroad companies benefited as transportation systems adapted to unstable fuel costs. The opportunities spread everywhere for those paying attention. A small energy logistics company in Oklahoma became one of the most profitable stocks in America during the crisis, simply because investors realized domestic fuel transport was becoming strategically critical. Nobody cared about the company before the war. That's how crisis wealth works. The biggest winners are often invisible before panic begins. A retired oil trader from Houston explained it brilliantly during an interview. By the time everyone knows oil is valuable, the real money is already gone. That statement frustrated many new investors because it sounded unfair. But markets are not designed to reward fairness. They reward anticipation. And anticipation requires understanding systems better than headlines. One of the biggest mistakes ordinary people made during the oil crisis was focusing only on crude oil prices themselves. They watched television discussing barrels, supply cuts, and geopolitical escalation, but they ignored the deeper financial ecosystem surrounding energy. Oil is not merely a commodity, it is an economic multiplier. When oil prices surge, entire chains of dependency become profitable. Storage companies profit, shipping firms profit, refinery services profit, equipment manufacturers profit, alternative energy firms profit, commodity exchanges profit. Even banks financing energy expansion profit enormously. The crisis created an entire universe of secondary opportunities, and the oil crisis millionaires understood this immediately. One famous hedge fund manager reportedly built enormous positions in companies manufacturing industrial pumps and drilling equipment before the public fully understood why energy infrastructure expansion would become necessary. Within months, those investments multiplied several times over. Not because pumps were exciting, because systems matter more than headlines. That's the hidden psychology of crisis investing. Most people chase visible drama. Professionals chase invisible infrastructure. And invisible infrastructure becomes priceless during instability. Another crucial lesson emerged quickly during the conflict. Governments always react slower than markets. Always. By the time politicians announced emergency energy measures, professional investors had already moved weeks earlier. By the time news anchors discussed inflation risks, commodity traders had already positioned themselves around transportation shortages and industrial cost expansion. Speed created enormous asymmetry. That's why many oil crisis millionaires spent more time studying shipping data, energy reserves, and military logistics than watching television. Television explains what already happened. Fortunes are built predicting what happens next. One investor from Connecticut became famous after correctly forecasting that the crisis would dramatically increase domestic American drilling activity regardless of political rhetoric. He quietly accumulated positions in small shale companies before policy changes accelerated. When emergency energy measures eventually loosened restrictions and domestic production expanded aggressively, those stocks surged explosively. Again, not luck. Consequence analysis. The average person sees events. The crisis investor studies reactions, and reactions create wealth. A fascinating psychological shift also occurred during the oil crisis. Public opinion toward fossil fuels changed dramatically under pressure. Before the conflict escalated, many institutions aggressively promoted rapid energy transition policies. But once energy security became uncertain, practical survival began overpowering ideological messaging. That created another wave of opportunity. Oil companies once considered politically unpopular suddenly became strategically essential. Investors who understood this emotional reversal early made extraordinary profits. One analyst called it the revenge of necessity, an unforgettable phrase. Because crises often expose the gap between aspiration and reality. The world wanted cleaner energy, but the world still depended on oil. And dependency creates leverage. That leverage turned energy executives into some of the most powerful people in America almost overnight. Politicians requested meetings. Television networks invited them constantly. Wall Street banks prioritized energy analysis above almost every other sector. Power shifted visibly. Silicon Valley looked uncertain. Houston looked unstoppable. And millions of ordinary investors rushed into energy markets far too late. That's another painful truth about financial panic. Crowds usually arrive after the biggest opportunities already passed. The first investors entered when fear was highest and uncertainty felt unbearable. Late investors entered when profits became obvious. That difference determines fortunes. A famous market saying returned constantly during the crisis: "The best trades feel terrifying when you enter them." That perfectly described energy investing during the first months of the Iran-Israel war. Nobody knew how bad the situation could become. Nobody knew whether shipping routes would remain open. Nobody knew whether the conflict would spread regionally. But uncertainty itself created the opportunity, because uncertainty creates underpricing before panic transforms into consensus. And consensus is where easy money ends. By the end of the second phase of the oil crisis, America had already produced a new class of wealthy investors: commodity traders, energy executives, infrastructure specialists, strategic analysts, shipping investors, people who understood one thing earlier than everyone else. Modern civilization cannot function without stable energy, and when stability disappears, money flows violently toward whoever restores it, controls it, or predicts its absence first. The public usually notices wealth too late. That's one of the oldest patterns in financial history. By the time ordinary people recognize a booming industry, the early fortunes have already been made quietly in the background. The oil crisis of 2026 followed the exact same pattern. When Americans finally started discussing energy opportunities openly on television and social media, the smartest investors were already looking beyond oil itself. Because oil was only the beginning. The real fortunes emerged in the shadows surrounding energy, infrastructure, transportation, security, storage, data, logistics. Everything civilization suddenly realized it could not survive without. One veteran commodity trader described the situation perfectly during a private financial conference in Manhattan. Crises never create one winning sector. They create entire winning ecosystems. That ecosystem exploded across America during the Iran-Israel conflict. And those who understood the ecosystem became rich faster than anyone else. The first major wave of oil crisis millionaires came directly from energy production itself. Oil companies surged dramatically as crude prices climbed. Small exploration firms that once struggled for investor attention suddenly became Wall Street favorites overnight. But the truly strategic investors quickly noticed something more important. If the crisis continued long enough, America would need massive infrastructure expansion to handle domestic energy demand. That realization changed everything. Pipeline companies surged, storage facilities surged, industrial construction firms surged, rail transport companies surged. Even manufacturers producing steel pipes and drilling machinery experienced explosive growth. Because oil is not valuable unless it moves, and movement requires systems. That's the third lesson of becoming wealthy during an oil crisis. Always follow the infrastructure beneath the commodity. A barrel of oil means nothing trapped underground. The real money often flows toward the businesses making energy usable, transportable, and secure. One investor from Dallas became legendary after buying positions in overlooked American refinery operators before fuel shortages intensified nationally. Most investors focused directly on oil prices. He focused on processing capacity. His reasoning was brutally simple. If crude rises dramatically, refining margins become strategic. He was right. His portfolio multiplied several times over, while ordinary investors chased headlines too late. That pattern repeated everywhere. The public chased visible chaos, professionals chased invisible bottlenecks, and bottlenecks create extraordinary wealth during crises. A fascinating example emerged in the shipping industry. As tensions near Middle Eastern shipping routes intensified, insurance costs for oil tankers skyrocketed. Many traditional shipping paths became dangerous or financially unsustainable. Suddenly, alternative transport networks became incredibly valuable. American rail systems transporting domestic fuel expanded rapidly. Port infrastructure companies surged. Even pipeline monitoring software firms experienced massive growth because governments feared sabotage and cyber attacks. This is where average investors usually fail during crises. They think too narrowly. They ask, should I buy oil? Smarter investors ask, what systems become critical if oil becomes unstable? That question creates fortunes. And America's biggest financial institutions understood this immediately. Wall Street banks launched emergency research divisions focused entirely on energy logistics and geopolitical risk. Hedge funds hired former military analysts, intelligence officers, and shipping experts to study the cascading effects of prolonged instability. Because by now, the crisis was no longer merely about fuel, it was about civilization's dependency on uninterrupted movement. And movement itself had become expensive. A trucking executive in Tennessee explained the situation bluntly during an interview. Everything in America arrives on fuel. If fuel breaks, everything breaks. That statement spread rapidly online because ordinary people finally started feeling the crisis personally. Food prices surged. Delivery costs surged. Construction costs surged. Airfare became painful. Everyday life became more expensive because energy touched every layer of the economy. But while the public suffered inflation, another class of millionaires emerged quietly: commodity speculators. These were not traditional investors building businesses over decades. These were highly aggressive traders, capable of reading fear faster than the crowd. They understood volatility itself had become valuable. One 26-year-old trader reportedly turned a $1 million commodity account into nearly $80 million during 6 months of oil volatility. How? Leverage, speed, and emotional discipline. The average person sees market swings and feels fear. Professional speculators see probability. That psychological difference is enormous. A famous hedge fund manager once explained it using an unforgettable analogy. The public experiences crises like storms. Traders experience crises like waves. Storms feel dangerous. Waves can be ridden. And during the oil crisis, volatility became the largest financial wave on Earth. Oil prices swung wildly based on military updates, refinery attacks, diplomatic negotiations, cyber warfare incidents, and shipping disruptions. A single rumor could move markets billions of dollars within minutes. Most people found this terrifying. Experienced traders found it profitable. Because uncertainty increases price movement, and price movement creates opportunity. That's why some of the fastest fortunes during the oil crisis were built not through long-term investment, but through mastering emotional chaos. A trader who remained calm while others panicked possessed an extraordinary advantage. And emotional discipline became more valuable than technical intelligence. One old Wall Street saying suddenly returned everywhere during the crisis: the market transfers money from the emotional to the disciplined. The oil crisis proved this brutally. Millions of Americans sold investments emotionally after inflation and fear intensified. Meanwhile, disciplined investors accumulated positions in sectors becoming strategically essential: energy, defense, cybersecurity, agricultural infrastructure, shipping systems. Resilience itself became profitable. That word, resilience, started dominating financial conversation by late 2026. Because investors finally realized the world was changing structurally. This was not simply another temporary recession. The global economy was entering a period where resilience mattered more than efficiency. That shift created entirely new opportunities. Companies producing backup power systems exploded upward. Industrial battery manufacturers surged. Domestic manufacturing firms expanded rapidly. Cybersecurity companies protecting critical infrastructure became investor favorites. The oil crisis millionaires understood one thing early: Every system exposed as fragile eventually creates a new industry dedicated to protection. And protection becomes extraordinarily profitable when fear spreads globally. A remarkable example emerged in the electricity sector. As energy instability intensified, several states experienced temporary grid stress and rolling blackouts during periods of extreme demand. Suddenly, home backup systems became a booming business. Generator manufacturers sold out nationwide. Solar storage firms surged. Private energy security became a luxury industry almost overnight. One entrepreneur who manufactured industrial battery systems became a billionaire within 2 years simply because he recognized where fear was heading before the public fully understood it. Again, not luck, pattern recognition. The ability to ask one critical question repeatedly. What becomes essential if instability continues? That question guided nearly every major oil crisis fortune. And perhaps the most important lesson of all emerged slowly as the crisis deepened. Millionaires were not created because oil prices rose. They were created because the crisis exposed dependency. Dependency on foreign energy, dependency on fragile supply chains, dependency on stable shipping routes, dependency on uninterrupted peace. Once those dependencies became visible, investors started hunting aggressively for businesses capable of reducing vulnerability. And vulnerability reduction became one of the most profitable sectors in modern history. America transformed financially during this period because the country adapted faster than most nations. Capital flowed aggressively toward domestic resilience. Energy independence became politically unstoppable. Infrastructure spending accelerated massively. Money moved toward survival, toward security, toward control. And the investors who recognized this transformation earliest became extraordinarily wealthy. Because they understood something ordinary citizens were only beginning to realize. The oil crisis was not just creating panic. It was rewriting the definition of value itself. The greatest fortunes during the oil crisis were not built by predicting missiles. They were built by predicting people. That distinction matters enormously. Most beginners entering financial markets during crises become obsessed with headlines. They watch wars, speeches, explosions, and emergency press conferences, believing information alone creates wealth. But professional investors understand something deeper. Human reaction to events creates wealth. And during the Iran-Israel conflict, human behavior became astonishingly predictable. Fear spread. Governments overreacted. Consumers panicked. Markets swung violently. And every emotional overreaction created opportunity for disciplined investors. A legendary commodity trader once said something that became almost philosophical during the crisis years. Markets are just crowds with money attached to emotions. That sentence explained nearly everything. The average American experienced the oil crisis emotionally. They worried about fuel prices, inflation, and survival. They reacted to headlines immediately because uncertainty naturally creates fear. Professional investors viewed the same crisis differently. They studied patterns, because human beings repeat emotional behavior constantly during emergencies. Panic buying, emotional selling, overconfidence during temporary relief, despair during sudden declines. The smartest oil crisis millionaires mastered these cycles almost scientifically. One hedge fund manager from Chicago reportedly built a billion-dollar fortune by studying consumer energy behavior during previous historical crises. He noticed something fascinating. Every time fuel prices surged dramatically, people initially panicked emotionally before gradually adapting behavior practically. First came fear, then adjustment. And those adjustments created entirely new investment opportunities. When gasoline prices crossed record levels nationwide, millions of Americans changed habits almost immediately. Driving declined sharply. Remote work expanded again. Public transportation usage increased in major cities. Smaller, fuel-efficient vehicles surged in popularity. Most people experience these changes personally. Smart investors monetize them. That's the fourth lesson of becoming wealthy during an oil crisis. Watch how society adapts under pressure. Adaptation creates the next wave of fortunes. A perfect example emerged in logistics. At first, rising fuel costs devastated transportation-heavy businesses. But within months, companies began redesigning entire delivery systems for energy efficiency. Warehousing moved closer to consumers. Regional distribution hubs expanded rapidly. AI-driven route optimization became extremely valuable. Investors who recognized this adaptation early made enormous profits. Not from oil directly, from humanity reorganizing itself around expensive energy. That's how crisis wealth compounds. The first wave rewards those predicting disruption. The second wave rewards those predicting adaptation. And the adaptation phase often creates even larger fortunes because it lasts longer. One Silicon Valley entrepreneur became famous after building software designed specifically to reduce fuel consumption for trucking fleets. Before the oil crisis, almost nobody cared about saving small percentages on transportation costs. After fuel prices exploded, his technology became indispensable. Within 18 months, his company's valuation increased beyond $20 billion. Again, the fortune was not built from oil itself. It was built from changing human behavior caused by oil. And that pattern spread across America rapidly. Consumers became more defensive financially. Businesses became more localized operationally. Governments became more aggressive strategically. Every shift in behavior created investment opportunities for those paying attention carefully. A veteran investor explained it brilliantly during a conference in Houston. The market does not reward the event. It rewards understanding what the event forces people to do next. That single sentence became almost a blueprint for oil crisis investing. Because once investors understood how fear changed behavior, entire industries suddenly became predictable. Home energy systems surged because people feared blackouts. Cybersecurity firms surged because governments feared infrastructure attacks. Domestic manufacturing expanded because corporations feared overseas dependency. Agricultural technology companies gained attention because food transportation became expensive. Fear redirected capital everywhere. And capital movement creates millionaires. One particularly fascinating shift happened inside American culture itself. Preparedness stopped being viewed as paranoia. It became intelligence. Families started storing emergency supplies. Businesses built redundancy into operations. Communities invested in local resilience systems. Preparedness became mainstream psychology. The financial markets reacted instantly. Generator companies surged. Water infrastructure firms surged. Battery manufacturers exploded upward. Even companies producing emergency food systems became unexpectedly profitable. The public believed they were buying safety. Investors understood they were buying a psychological trend. That's another hidden truth about crisis wealth. Fear creates industries. Entire billion-dollar sectors emerged during the oil crisis simply because society lost confidence in uninterrupted stability. And once confidence disappears, people willingly spend enormous amounts protecting themselves emotionally. A financial analyst described the phenomenon perfectly during a televised interview. The most valuable product during uncertainty is reassurance. Reassurance. That word became unbelievably important because every successful business during the crisis ultimately sold some form of reassurance. Oil companies sold energy security. Defense firms sold national security. Technology firms sold operational security. Preparedness industries sold personal security. The world had entered an economy driven by anxiety management, and the smartest investors recognized it before everyone else. One private equity firm made billions purchasing regional utility infrastructure during periods of public panic. Why? Because they understood governments would eventually prioritize energy resilience politically, no matter the cost. Again, they weren't investing emotionally, they were studying inevitable human reaction. That's what separates oil crisis millionaires from ordinary investors. Ordinary people react to fear. Professional investors map the consequences of fear, and consequences create wealth. Perhaps the most powerful example came from real estate. At the beginning of the crisis, housing markets weakened under inflation pressure. But then something interesting happened. People started relocating strategically. Energy-efficient communities became more attractive. Walkable cities gained value. Homes with solar infrastructure surged in demand. Properties near strong domestic energy networks appreciated rapidly. Investors who noticed these migration patterns early built enormous wealth quietly. Not because they predicted exact headlines, because they understood how expensive energy reshapes human geography. And expensive energy reshapes almost everything: where people live, where companies operate, how products move, how governments prioritize spending, how families organize life. Oil crises are never only about oil. They are about behavioral transformation. That's why some of the largest fortunes during the Iran-Israel conflict came from industries that initially seemed unrelated to energy entirely. Artificial intelligence firms optimizing energy efficiency, agricultural robotics companies reducing transportation dependence, regional manufacturing systems, data infrastructure protecting supply chains. The crisis accelerated every technology capable of reducing vulnerability, because vulnerability became expensive, and reducing vulnerability became priceless. One investor summarized the entire era in a single, unforgettable sentence: "The future belongs to whoever helps civilization function under stress." That became the defining philosophy of oil crisis wealth. Not luxury, not speculation, functionality under pressure. The investors who understood this early became extraordinarily rich because they stopped thinking like gamblers and started thinking like system architects. They asked deeper questions. How does society survive instability? What becomes essential during fear? Which systems cannot fail? And most importantly, who gets paid to keep civilization moving when everything else becomes uncertain? The answers to those questions created the next generation of millionaires. Because by now, one truth had become impossible to ignore. The oil crisis was not simply a financial event. It was a global behavioral reset. And behavior, more than oil itself, was the most profitable commodity on Earth. By the final stage of the oil crisis, the public finally understood something the earliest investors recognized years before. The world had changed permanently. Not temporarily, not politically, structurally. And once that realization settled into the American mind, wealth began flowing differently forever. The old economy rewarded convenience. The new economy rewarded resilience. That single transformation created an entirely new class of millionaires. And almost all of them shared one characteristic. They stopped thinking like consumers. They started thinking like survival architects. That's the fifth and most important lesson of becoming wealthy during an oil crisis. Fortunes are not built by chasing panic. They are built by understanding what civilization cannot afford to lose. The Iran-Israel war exposed those vulnerabilities brutally. Energy, infrastructure, food systems, transportation, cybersecurity, domestic production. Every weak point inside the modern global economy suddenly became visible under pressure. And investors who recognized these weaknesses early positioned themselves ahead of the largest transfer of wealth in modern history. One billionaire energy investor described it perfectly during a private conference attended by global financial leaders. The crisis did not create new value. It revealed where real value always existed. That sentence became legendary because it explained why certain people became unimaginably rich, while others struggled simply to survive inflation. Oil crisis millionaires did not merely invest in rising prices. They invested in necessity itself. And necessity is the strongest force in every economy. People can cancel vacations, delay luxury purchases, avoid entertainment spending, but they cannot stop needing energy. They cannot stop needing food. They cannot stop needing transportation. And whoever controls necessities during instability gains enormous financial leverage. That's exactly what happened in America during the crisis years. Energy executives became more influential than celebrities. Commodity traders became more powerful than traditional bankers. Infrastructure investors became more important than tech visionaries. The center of economic gravity shifted visibly, and Wall Street adapted immediately. Banks stopped asking, "What's trendy?" They started asking, "What survives disruption?" That psychological shift changed investment strategy permanently. Speculative fantasies weakened, strategic assets strengthened. Investors poured money aggressively into industries tied to national resilience: domestic manufacturing, water infrastructure, nuclear energy, agricultural automation, critical minerals, defense technology, supply chain protection. The age of stability investing quietly ended. The age of resilience investing began, and the smartest oil crisis millionaires positioned themselves before the public fully accepted this reality. One private investor from Texas became incredibly famous after turning a small energy infrastructure portfolio into billions over several years. When asked how he identified the opportunity so early, his answer sounded almost absurdly simple. "I asked what governments would become desperate to protect." That answer contained enormous wisdom, because governments reveal priorities during emergencies. And during the oil crisis, governments around the world became obsessed with securing critical systems: energy grids, shipping routes, food supply chains, communication networks. Whoever built, protected, or controlled those systems became strategically essential. And strategic necessity creates wealth faster than hype ever can. Another extraordinary shift happened quietly beneath the surface of society. The definition of wealth itself changed. Before the crisis, wealth often meant visible luxury: fast cars, expensive watches, vacation homes. After the crisis, real wealth became something different entirely: control, stability, independence. The truly wealthy no longer impress people with extravagance. They impress people with insulation from chaos, private energy systems, secure supply chains, self-sufficient properties, strategic investments tied to essential infrastructure. That was the new status. And ordinary Americans noticed this transformation immediately. The rich were not preparing for growth anymore. They were preparing for volatility. That realization changed public psychology deeply. Preparedness stopped looking extreme. It started looking rational. Families built emergency savings aggressively. Communities focused on local resilience. Businesses prioritized operational survival over rapid expansion. The entire culture shifted from optimization toward protection. And once again, investors who recognized the emotional shift early became rich. Because every societal fear creates new economic demand. Fear of shortages creates storage industries. Fear of blackouts creates backup power industries. Fear of instability creates security industries. Fear of dependency creates domestic manufacturing opportunities. Every fear eventually becomes a business model. That may be the most uncomfortable truth about modern capitalism. Human anxiety is incredibly profitable. One market analyst summarized the entire oil crisis era in a sentence that spread worldwide. The 21st century economy runs on fear as much as fuel. Harsh words, but accurate. And the investors who accepted this reality emotionally outperformed everyone else. Because they stopped resisting the nature of the system, they adapted to it. That adaptation created the largest fortunes of the era. One hedge fund manager reportedly earned more money during 3 years of geopolitical instability than during the previous 15 years combined. His strategy was surprisingly simple. Invest in what governments cannot allow to fail. That philosophy guided many of the greatest oil crisis fortunes. Critical energy infrastructure, defense systems, cybersecurity networks, transportation logistics, food distribution, water systems, the essential machinery of civilization itself became the safest and most profitable investment category on Earth. And perhaps that was the final lesson the Iran-Israel conflict taught the financial world. Civilization is much more fragile than people imagine. The average citizen usually notices this only during emergencies. Professional investors think about fragility constantly, because fragility creates opportunity. One famous trader ended a television interview with a statement that perfectly captured the mindset of every oil crisis millionaire. When systems become unstable, money flows towards certainty. Certainty. That was the real commodity behind every fortune built during the crisis. Not oil itself, certainty. The ability to provide fuel, provide transportation, provide security, provide infrastructure, provide continuity while the world felt unstable. And once investors understood that principle, the path to wealth became much clearer. The richest people during the oil crisis were rarely gamblers chasing headlines emotionally. They were builders of stability, owners of necessity, controllers of infrastructure, predictors of human behavior. That's why the biggest fortunes lasted long after oil prices stabilized. Because the true winners were never merely betting on higher crude prices. They were investing in a world permanently transformed by fear. And fear changes civilizations for generations. By the end of the crisis era, America itself had changed profoundly. People viewed globalization differently, energy differently, security differently. The illusion of permanent stability disappeared forever. But for a small group of disciplined investors, entrepreneurs, and strategic thinkers, that instability became the greatest financial opportunity of their lives. Not because they caused the crisis, because they understood the system underneath it. And understanding systems is ultimately how every great fortune is built, especially when the world is afraid. Every oil crisis creates the same question. If so much wealth is being made, why doesn't everyone benefit? The answer is uncomfortable, because crises expose the difference between reaction and preparation. Most ordinary people enter survival mode during economic shocks. They focus on protecting income, reducing expenses, and avoiding risk. Emotionally, that response makes perfect sense. Fear naturally pushes human beings towards safety. But financial history reveals something brutal. The largest fortunes are often created precisely when the majority of society becomes too afraid to act. That's why oil crisis millionaires always appear almost unreal to the average person. While entire populations worry about inflation and uncertainty, a small group of investors somehow becomes dramatically richer. Not because they are superhuman, because they understand timing. A famous Wall Street veteran once explained it with a sentence that sounded almost cruel. The crowd seeks comfort. Wealth seeks asymmetry. Asymmetry. That word became one of the hidden secrets behind the oil crisis fortunes of 2026. Because asymmetric opportunities appear when potential reward becomes massively larger than potential risk. And geopolitical crises create these moments constantly. When the Iran-Israel conflict escalated, most people immediately focused on danger. Smart investors focused on imbalance. Which industries would governments desperately protect? Which businesses would become unavoidable necessities? Which sectors could absorb inflation while others collapsed? The answers pointed repeatedly toward the same areas: energy, defense, infrastructure, cybersecurity, transportation resilience. The public saw fear. The oil crisis millionaires saw inevitability. That distinction changes financial outcomes dramatically. One retired commodity trader described the psychology perfectly during a financial seminar in Dallas. Ordinary people ask, "What if everything goes wrong?" Wealthy investors ask, who gets paid if everything goes wrong? That question created billions during the oil crisis. Because once instability spreads through the economy, certain systems become more valuable automatically. Power generation, fuel transportation, food logistics, emergency infrastructure. Governments cannot allow these systems to fail completely, and investors who understand government desperation gain enormous advantage. That's another painful truth about becoming wealthy during crises. Governments eventually reveal where money will flow. During the Iran-Israel war, trillions moved toward strategic stability. Emergency energy policies accelerated. Infrastructure spending expanded. Domestic production incentives exploded. National resilience became a political obsession. The smart money moved before these policies became obvious publicly. Again, preparation beat reaction. One young investor from Colorado reportedly became a multi-millionaire after recognizing that domestic rail systems would become strategically important if fuel instability disrupted traditional trucking routes. Nobody paid attention initially. Railroads sounded old-fashioned, unexciting. But crises do not reward excitement, they reward necessity. And necessity became the central theme of every major oil crisis fortune. That's the sixth lesson of becoming wealthy during an oil crisis. Stop chasing excitement, start studying dependence. Dependence reveals where money eventually flows. What does society absolutely require regardless of economic pain? What systems become non-negotiable during instability? What industries gain leverage when fear spreads? The answers create enormous opportunity. And yet most people still fail to capitalize on crises. Why? Because human psychology works against long-term wealth creation during emergencies. Fear narrows thinking. People become emotionally short-term. They focus only on immediate survival rather than structural transformation. But structural transformation is where the real money exists. The oil crisis was not merely increasing fuel prices, it was redesigning economic priorities globally. Domestic production became more valuable. Energy independence became more valuable. Infrastructure security became more valuable. Local supply chains became more valuable. Everything tied to resilience appreciated financially. And investors who recognized the long-term shift became rich far beyond temporary commodity speculation. A private equity manager explained this brilliantly during an interview. Most people thought the crisis was about expensive oil. The real opportunity was expensive fragility. Expensive fragility. That phrase captured the entire investment landscape perfectly. Because once the world realized how fragile modern systems actually were, enormous capital began flowing toward reducing vulnerability. Companies offering stability became priceless. One startup focused on protecting electrical grids from cyber attacks increased in value by several thousand% during the crisis years. Not because cybersecurity suddenly became fashionable, because unstable energy systems became national security threats. Again, secondary consequences created the largest fortunes. The public looked directly at oil. Millionaires looked at everything oil touched. That wider perspective changed outcomes dramatically. Another reason ordinary people struggle during crises is leverage. Not just financial leverage, emotional leverage. Wealthy investors often possess enough capital and emotional distance to tolerate uncertainty longer than the average person. They can survive volatility while waiting for trends to mature. Most ordinary families cannot. Inflation pressures force immediate decisions. Rising costs reduce flexibility. Fear encourages short-term thinking. That's why crises often widen wealth inequality so aggressively. The rich can wait, the poor must react. And reaction rarely creates massive wealth. One billionaire investor admitted this openly during a conference in New York. The greatest financial advantage is not intelligence, it's the ability to remain calm while everyone else panics. Calm became a weapon during the oil crisis because panic creates mispricing. Markets overreact emotionally. News cycles exaggerate fear. Crowds rush towards safety too late, and disciplined investors quietly position themselves while uncertainty feels unbearable. That's exactly what happened repeatedly during the Iran-Israel conflict. Every escalation triggered emotional selling in vulnerable sectors and emotional buying in strategic sectors. Smart investors anticipated these reactions before they occurred. They understood crowd psychology, and crowd psychology became predictable. A missile strike happens, oil surges, airlines fall, defense stocks rise, infrastructure protection firms rise, commodity volatility expands. The pattern repeated often enough that experienced investors almost treated geopolitical panic mathematically. That may sound cold, but financial markets are not moral systems. They are adaptive systems, and adaptive systems reward prediction. One former military analyst turned hedge fund advisor became enormously wealthy simply because he understood how governments behave under prolonged energy stress. He recognized that energy security would eventually dominate national policy, regardless of ideological debates. He invested accordingly. His fortune multiplied. Again and again, the same principle appeared beneath every oil crisis success story. The winners studied systems. The losers reacted to symptoms. Symptoms create emotional panic. Systems create strategic clarity. That's why some of the richest people during the crisis spent less time watching breaking news and more time studying infrastructure maps, shipping routes, energy reserves, industrial bottlenecks, and political incentives. They were not predicting headlines. They were predicting pressure points. And pressure points determine where money flows during instability. Perhaps the most important realization of all emerged slowly as the years passed. Oil crises do not create wealth equally because information, capital, and emotional discipline are not distributed equally. That's the uncomfortable reality. Some people see inflation and freeze. Others see inflation and reposition. Some people fear uncertainty. Others monetize it. And history consistently rewards the people capable of remaining strategic while society becomes emotional. That's why the oil crisis millionaires were never simply lucky traders gambling during chaos. They were individuals who understood one brutal economic truth earlier than everyone else. When civilization becomes unstable, the value of certainty explodes. By the time the average American realized the oil crisis was serious, many of the largest fortunes had already been positioned quietly behind the scenes. That is perhaps the most frustrating truth about modern wealth creation. The public reacts to events. The wealthy prepare for probabilities. And probabilities always appear earlier than headlines. Months before the Iran-Israel war officially exploded into global panic, certain investors had already started moving aggressively into energy markets. Not because they possessed magical powers, not because they controlled governments, because they understood patterns. Military tensions were rising, shipping insurance costs were climbing, strategic oil reserve discussions had intensified quietly. Satellite data showed unusual naval activity near critical energy routes. The signals existed. Most people ignored them because human beings naturally assume stability will continue until disruption becomes undeniable. Professional investors think differently. They ask one dangerous question constantly: what if the world changes faster than people expect? That question creates enormous wealth during crises. One former intelligence analyst turned hedge fund advisor became famous after correctly forecasting prolonged energy instability nearly 6 months before the first major market panic. During an interview later, he explained his process very simply. I stopped listening to political speeches and started watching logistics. Logistics. That single word reveals how sophisticated crisis investing actually works. Oil crises are not merely geopolitical events. They are supply chain events, transportation events, infrastructure events. Everything depends on movement. and movement leaves signals long before panic reaches the public. Shipping routes tighten, insurance rates rise, military positioning changes, energy reserves shift, commodity contracts behave differently. The clues appear everywhere for those trained to see them. That's the seventh lesson of becoming wealthy during an oil crisis. The greatest fortunes are usually built before the crowd emotionally accepts reality. Once the public fully believes a crisis exists, easy money often disappears quickly. The earliest investors always possess the largest advantage because uncertainty creates underpricing. Markets hesitate when outcomes feel unclear, and uncertainty is where asymmetric opportunity lives. A famous commodity trader once explained it with an unforgettable sentence: "The best trades happen when intelligent people still disagree." By the time everyone agrees oil is valuable during a crisis, valuations often become crowded and emotional. But earlier, during the confusion phase, opportunities remain enormous. That confusion phase created many oil crisis millionaires. One private investor from Houston quietly accumulated shares in domestic energy infrastructure companies, while major financial media still dismissed Middle Eastern tensions as temporary political theater. His reasoning was brutally practical. If shipping instability expands, America will become desperate for domestic resilience. That prediction turned into billions. Again, not luck, consequence analysis. The public saw diplomacy, he saw dependency, and dependency creates leverage. That distinction changed financial outcomes dramatically throughout the crisis years. Another fascinating pattern emerged among the wealthiest investors during the oil crisis. They rarely concentrated only on one obvious trade. Instead, they built systems of exposure: energy production, transportation infrastructure, cybersecurity, industrial materials, defense logistics, agricultural resilience. Why? Because they understood that major crises spread pressure unevenly across entire economies. A rise in oil prices affects airlines negatively, but benefits rail transport, benefits domestic manufacturing, benefits energy storage, benefits infrastructure expansion. The smartest investors mapped these ripple effects before the public understood them emotionally. That's how wealth compounds during instability, not through one perfect prediction, through interconnected positioning. One Wall Street strategist called it building a crisis ecosystem portfolio. A fascinating phrase, because that's exactly what oil crisis millionaires were really doing. They weren't merely betting on war, they were investing in how civilization reorganizes itself under stress. And civilization always reorganizes around necessity. A young investor from Florida became enormously wealthy after noticing something almost nobody discussed publicly during the early stages of the conflict. Data centers consumed massive amounts of electricity. Artificial intelligence infrastructure depended heavily on stable energy access. If energy volatility expanded globally, companies capable of stabilizing digital infrastructure would become strategically critical. He invested aggressively in grid technology and energy optimization systems before public awareness exploded. His fortune multiplied rapidly. Again, not because he predicted exact headlines, because he identified hidden dependencies. Dependencies are where the biggest money lives during crises. Most ordinary people focus only on visible products: oil, gasoline, fuel prices. Professional investors focus on underlying systems: power grids, transport networks, industrial bottlenecks, storage capacity, the invisible architecture supporting modern civilization. And once instability threatens that architecture, capital floods toward protection immediately. That's another reason ordinary people often miss the biggest opportunities. The most profitable sectors during crises usually appear boring before panic arrives. Pipelines are boring. Electrical transformers are boring. Industrial storage facilities are boring, until civilization suddenly depends on them desperately. Then they become priceless. One billionaire investor explained this brilliantly during a financial conference in Chicago. The market pays the highest premiums for boring things that become essential unexpectedly. That sentence perfectly described the oil crisis economy. Infrastructure became glamorous because fragility became terrifying. The public gradually realized how vulnerable modern systems actually were. Energy shortages could affect food distribution. Cyber attacks could affect power grids. Shipping disruptions could affect inflation globally. Everything connected. And connected systems create cascading opportunity. One particularly smart group of investors focused heavily on regionalization during the crisis years. They predicted that globalization would weaken under prolonged instability, forcing industries to move closer to domestic supply networks. That prediction changed entire fortunes. Local manufacturing surged. Regional logistics companies exploded upward. American industrial real estate gained enormous value. Domestic resilience became one of the largest investment themes in decades. Again, not because of ideology, because instability changes incentives. That's one of the deepest truths behind oil crisis wealth. Crises rewrite economic priorities very quickly. Before the conflict, companies optimize for efficiency. After the conflict, companies optimize for survivability. That shift created trillions of dollars in capital movement. And the earliest investors positioned themselves before governments publicly admitted these transformations were necessary. One former Federal Reserve advisor later admitted something fascinating during an interview. Financial markets adapted to the new reality faster than governments did. That always happens during crises. Markets move emotionally first, then strategically. Governments move politically, which usually means slower. And slowness creates opportunity for prepared investors. The oil crisis millionaires understood this clearly. They knew governments would eventually prioritize domestic energy security, strategic infrastructure, and supply chain resilience no matter the political cost. So they invested ahead of policy. That's where enormous wealth emerged. A common misconception among ordinary people is that becoming wealthy during crises requires predicting exact events perfectly. It doesn't. It requires understanding direction. Direction matters more than precision. If energy insecurity increases, certain sectors inevitably gain importance. If globalization weakens, regional infrastructure inevitably strengthens. If instability expands, resilience inevitably becomes profitable. The details change. The direction remains consistent, and consistent direction creates fortunes. By the later years of the oil crisis, many of the biggest winners were no longer even talking about oil directly. They talked about systems, strategic dependence, national resilience, critical infrastructure, because they understood something the public was only beginning to recognize. The real wealth was never hidden inside the barrel of oil itself. It was hidden inside everything civilization could not function without once oil became unstable. Fear changes people faster than facts. That became one of the defining realities of the oil crisis years. Most Americans did not study energy markets. They did not analyze shipping routes, geopolitical pressure points, or infrastructure vulnerabilities. They simply felt pressure emotionally as prices climbed and uncertainty spread through everyday life. Gasoline became expensive, food became expensive, travel became stressful, and slowly, fear entered ordinary decision-making. Families delayed purchases, businesses slowed expansion, consumers became defensive. The public responded psychologically long before they fully understood the economics. But the oil crisis millionaires understood something deeper. Fear itself was becoming the largest market force on Earth, and whoever understood fear could position themselves ahead of entire populations. A famous investor once said during a private conference that later leaked online, "People think oil drives markets during crises. Emotion drives markets." That statement sounded dramatic at first, but the numbers proved it repeatedly. Oil prices often surged on rumors before actual disruptions occurred. Markets collapsed on fears of shortages long before shortages materialized physically. Investors reacted emotionally to uncertainty faster than governments could issue official responses. The economy became psychological, and psychological economies create enormous opportunities for disciplined investors. That's the 8th lesson of becoming wealthy during an oil crisis. Study emotion as carefully as economics, because crises spread through human psychology before they spread through financial systems. One hedge fund manager became extraordinarily rich simply by understanding how public fear evolved in stages. At first, people dismissed the conflict as temporary. Then they panicked emotionally. Then they adapted behavior. Then they normalized instability. Each stage created different investment opportunities. The early stage rewarded energy exposure. The panic stage rewarded volatility trading. The adaptation stage rewarded resilience infrastructure. The normalization stage rewarded long-term strategic positioning. Most ordinary people never recognize these phases consciously. Professional investors map them carefully. That's why some oil crisis millionaires appeared almost supernatural in hindsight. They seemed to predict every shift correctly. But they weren't predicting headlines. They were predicting human reaction patterns. And human reaction patterns repeat constantly during uncertainty. A fascinating example emerged in consumer behavior. During the first wave of fuel panic, Americans rushed emotionally toward electric vehicles. EV companies surged rapidly. Investors poured money aggressively into alternative energy sectors. But smarter investors noticed a hidden problem. Electrical grids themselves were becoming unstable under pressure. That realization changed everything. The next wave of wealth shifted toward energy storage, grid resilience, nuclear infrastructure, and localized power systems. Again, not because investors were reacting emotionally, because they were studying second-order consequences. That's where the largest fortunes always hide. Second-order thinking became almost a superpower during the oil crisis. The average person asked, "What is happening?" Millionaires asked, "What happens next because this is happening?" That subtle difference separates survival from extraordinary wealth. One private investor from California became famous after building massive positions in water infrastructure and agricultural technology during the crisis years. At first glance, the investment seemed unrelated to oil, but his logic was brilliant. If energy costs remain unstable long-term, food systems become more vulnerable. If food systems become vulnerable, water efficiency and localized agriculture become strategically critical. His investments multiplied enormously over the following years. Again, not luck, chain reaction thinking. The oil crisis millionaires constantly thought in chains. If oil rises, transportation weakens. If transportation weakens, local production strengthens. If local production strengthens, regional infrastructure gains value. Every crisis creates cascading consequences, and cascading consequences create compounding wealth opportunities. Another critical insight emerged during the later stages of the conflict. Governments fear panic almost as much as they fear shortages. That realization changed investment strategy dramatically. Because once governments become desperate to preserve public confidence, they start spending aggressively on stability. Energy subsidies, infrastructure protection, emergency logistics, strategic reserves, cybersecurity, preparedness programs. The public saw government reaction. Professional investors saw government spending. And government spending creates enormous wealth for the sectors positioned correctly beforehand. One former defense contractor executive explained this openly during an interview. When politicians become afraid, budgets become limitless. A brutal sentence, but historically accurate. Fear expands spending faster than optimism ever can. That's why defense companies, cybersecurity firms, and infrastructure providers experienced extraordinary growth during the oil crisis years. Governments could not politically afford systemic collapse, so they spent aggressively preventing it. and the investors positioned ahead of those spending waves became rich beyond imagination. Another fascinating psychological transformation happened quietly inside America during the crisis era. People stopped trusting uninterrupted abundance. That sounds abstract until you understand the financial implications. For decades, consumers assumed products would always remain available. Supply chains would always function. Energy would always flow. Transportation would always remain affordable. The oil crisis shattered those assumptions permanently. And once assumptions collapse, consumer behavior changes for years. Preparedness industries exploded. Storage industries exploded. Backup systems exploded. Insurance-related sectors exploded. People began spending enormous amounts protecting themselves emotionally from uncertainty. The smartest investors recognized this before the public fully understood what they were feeling. One entrepreneur became a billionaire selling residential energy independence systems, not because the technology was revolutionary, but because fear was. That's another uncomfortable truth about modern wealth creation. Human anxiety is scalable. If millions of people fear instability simultaneously, entire trillion-dollar industries emerge around emotional protection. And crises accelerate that process dramatically. A Wall Street analyst described it perfectly during a televised debate. The public buys products, fear buys reassurance. Reassurance became the most valuable commodity of the oil crisis years. Companies selling stability thrived. Companies selling certainty thrived. Companies reducing dependency thrived. Every successful business ultimately solved emotional insecurity caused by instability. That's why the richest oil crisis millionaires rarely focused on temporary speculation alone. They focused on permanent psychological shifts. And perhaps the most important psychological shift of all was this: people no longer believed stability was guaranteed. That realization changed markets forever. Consumers became more defensive. Governments became more strategic. Corporations became more localized. Investors became more focused on resilience than growth. The entire economy emotionally reorganized around uncertainty, and uncertainty itself became extraordinarily profitable. One billionaire investor ended an interview with a sentence that perfectly summarized the entire crisis era. The greatest fortunes were made by people who understood that fear changes civilization faster than war. That was the real engine behind oil crisis wealth. Not merely rising oil prices, not merely geopolitical chaos, but the massive emotional transformation caused when billions of people suddenly realized how fragile modern life actually was. And once fear exposed that fragility, money flowed endlessly toward whoever could offer stability. The old version of wealth was simple: build a successful business, sell a product people love, expand operations, grow profits over time. That model still existed during the oil crisis years, but it was no longer the fastest path to enormous wealth. Because during instability, the most valuable thing on earth stops being popularity. It becomes control. Control over energy, control over logistics, control over infrastructure, control over movement itself. And the investors who understood this became the new rulers of the crisis economy. A famous geopolitical strategist once said something that sounded almost frightening during an interview watched by millions. In peaceful times, wealth comes from innovation. In unstable times, wealth comes from control. That sentence perfectly explained the rise of the oil crisis millionaires. The biggest fortunes were not built by inventing exciting new consumer products. They were built by controlling systems society could not survive without. Pipelines, electrical grids, storage facilities, shipping routes, data infrastructure, food logistics. The hidden machinery of civilization suddenly became more important than glamorous industries. And Wall Street adapted instantly. Investors stopped chasing fantasy growth stories and started hunting strategic leverage. The phrase critical infrastructure became one of the most valuable concepts in modern finance. Because once instability spreads through the global economy, governments become desperate to protect essential systems, and desperation creates enormous financial opportunity. One infrastructure investor from Texas reportedly became worth over $12 billion simply by acquiring regional energy storage facilities before shortages intensified nationwide. Storage, something most ordinary people never think about. But during crises, storage becomes power. That's the 9th lesson of becoming wealthy during an oil crisis. Control bottlenecks, not headlines. Headlines create temporary attention. Bottlenecks create permanent leverage. A bottleneck is anything civilization depends on that cannot be replaced quickly. Energy terminals, shipping access, industrial materials, refining capacity, cybersecurity infrastructure. The oil crisis exposed bottlenecks everywhere, and every exposed bottleneck became a money machine. One of the smartest investors during the conflict built enormous positions in companies manufacturing industrial transformers for electrical grids. Before the crisis, the industry looked boring and slow-moving. Then cyber attacks and energy instability exposed how vulnerable national power systems actually were. Suddenly, governments around the world scrambled desperately for grid resilience upgrades. Transformer demand exploded. The investor became extraordinarily wealthy. Again, not because he predicted every geopolitical event perfectly, because he understood where civilization was weakest. Weakness creates urgency. Urgency creates spending, and spending creates wealth. That pattern repeated constantly during the oil crisis years. The public focused emotionally on visible problems: fuel prices, inflation, conflict headlines. Professional investors focused on invisible dependencies. What systems fail if pressure continues? What industries become strategically irreplaceable? Who controls the pressure points? Those questions built fortunes. One retired military officer turned private equity manager explained it brilliantly during a conference in Washington. The world changed when investors stopped asking what people wanted and started asking what governments could not allow to fail. That shift transformed modern capitalism completely. Before the crisis, markets rewarded convenience and entertainment aggressively. After the crisis, markets rewarded resilience and strategic necessity. And strategic necessity often looks boring before panic begins. Oil pipelines are boring. Cargo terminals are boring. Industrial storage systems are boring, until the world suddenly cannot function without them. Then they become priceless. A fascinating transformation also occurred inside corporate America during the later crisis years. Large corporations stopped optimizing purely for efficiency. They started optimizing for control. Control over supply chains, control over energy access, control over domestic production, control over logistics. Because the crisis taught executives a painful lesson. Dependency is vulnerability, and vulnerable companies lose power quickly during instability. That realization created another massive wave of oil crisis wealth. Domestic manufacturing surged. Strategic mineral investments surged. Regional supply chain firms surged. The companies helping America reduce dependence on fragile international systems became extraordinarily valuable. One billionaire investor summarized the situation perfectly. The future belongs to whoever owns the systems panic cannot bypass. That sentence became almost prophetic because panic changes consumer behavior rapidly, but civilization still requires infrastructure. Planes still need fuel. Food still needs transportation. Electricity still needs distribution. Essential systems continue functioning regardless of fear. And whoever controls essential systems gains enormous leverage over society itself. That leverage became visible politically too. Energy executives suddenly possessed extraordinary influence in Washington. Infrastructure firms received massive government contracts. Cybersecurity companies protecting critical systems became strategically tied to national security policy. Financial power and political power merged aggressively during the crisis years. The oil crisis millionaires were no longer simply investors. Many became architects of the new economic order. That frightened a lot of people, because ordinary Americans increasingly realized something uncomfortable. The people profiting most from instability also controlled many of the systems required to manage instability. And once populations notice that relationship, trust weakens rapidly. One journalist wrote a sentence during the later stages of the crisis that became internationally famous. The old billionaires sold convenience. The new billionaires sell continuity. Continuity. That word defined the new economy perfectly. People no longer paid premium prices merely for luxury or entertainment. They paid premiums for reliability. Reliable energy, reliable infrastructure, reliable logistics, reliable access to necessities. Stability itself became a luxury commodity, and the oil crisis millionaires built fortunes selling access to that stability. Another critical pattern emerged during this era. The richest investors increasingly avoided industries dependent on optimism. They preferred industries dependent on inevitability. That distinction matters enormously. Optimism fluctuates emotionally. Inevitability creates predictable demand. People might stop buying luxury products during crises. They do not stop needing electricity. They do not stop needing transportation. They do not stop needing food systems. The investors who shifted from optimistic industries toward inevitable industries became the biggest winners of the oil crisis era. One former hedge fund manager explained this philosophy during an interview. The safest fortune is built around things civilization cannot negotiate with. That's why strategic sectors outperformed almost everything else during prolonged instability. Not because they were exciting, because they were unavoidable. And unavoidable systems create recurring leverage. The smartest oil crisis millionaires eventually stopped thinking like traders entirely. They started thinking like governments. National resilience, energy independence, infrastructure security, supply chain durability. These became the core investment themes of the age. And once investors aligned themselves with long-term national priorities, enormous wealth followed naturally. A fascinating irony emerged from all this. The biggest fortunes during the oil crisis were often built from industries the financial world once considered outdated. Oil, manufacturing, transportation, infrastructure, agriculture, physical systems. For years, modern markets obsessed over virtual economies and digital lifestyles. Then one geopolitical crisis reminded everyone of a timeless truth. Civilization still depends on physical reality. Fuel moves trucks. Trucks move food. Infrastructure moves economies. And whoever controls movement controls power. That may have been the deepest lesson behind all the oil crisis fortunes. The millionaires who won were not necessarily smarter than everyone else. They simply understood earlier than the public that modern wealth is ultimately built on control over systems society cannot survive without. And once instability exposed those systems, the money flowed endlessly toward whoever owned them. At the end of every great crisis, people ask the same question. How did a small group become so rich while the world struggled? The answer is never simple, but during the oil crisis of 2026, one truth became impossible to ignore. The biggest fortunes were not created by oil alone. They were created by understanding human civilization itself. Because the Iran-Israel conflict ultimately exposed something far deeper than geopolitical tension. It exposed the invisible architecture holding modern life together. Energy, infrastructure, trust, movement, stability. The people who became wealthy during the crisis recognized these foundations before the public fully understood them. And once fear entered the system, money moved violently toward whatever could preserve continuity. That was the final secret. Oil crisis millionaires were not merely investing in rising fuel prices. They were investing in the survival mechanisms of civilization. A famous investor who emerged from the crisis years gave an interview near the peak of his financial success. When asked what he learned from the era, he answered with a sentence that stunned viewers. "The world doesn't pay the highest rewards to people who predict the future. It rewards people who understand what humanity cannot live without." That sentence summarized the entire crisis perfectly. Because once instability spread globally, priorities changed immediately. Luxury became less important. Convenience became less important. Entertainment became less important. Necessity became everything. And whoever controlled necessity gained extraordinary leverage. That's why the final phase of oil crisis wealth creation looked very different from the beginning. Early fortunes came from volatility and rapid positioning. Later fortunes came from ownership of infrastructure, ownership of strategic systems, ownership of resilience itself. The smartest investors eventually stopped behaving like traders chasing temporary opportunities. They became long-term owners of critical assets tied directly to national survival. Energy grids, transportation corridors, agricultural systems, cybersecurity infrastructure, domestic manufacturing. These sectors became the backbone of the new economy because they represented continuity during uncertainty, and continuity became priceless. One former Federal Reserve advisor explained the transformation brilliantly during a conference in New York. The crisis changed the definition of value. Stability became more valuable than growth. That single sentence explains why so many traditional investment assumptions collapsed during the oil crisis years. Before the conflict, investors chased expansion aggressively. After the conflict, they chased durability. A company capable of surviving instability became more attractive than a company promising rapid growth during stable conditions. This psychological shift changed global finance permanently. The age of efficiency gave way to the age of resilience, and resilience created enormous fortunes. One billionaire investor from Houston became famous after buying distressed industrial infrastructure during periods of maximum public panic. While ordinary investors fled uncertainty emotionally, he quietly accumulated assets tied to energy, transportation, and domestic manufacturing. Years later, those assets became some of the most strategically valuable systems in America. When asked why he remained calm during the chaos, he answered simply, "Civilization still has to function tomorrow." That mindset separated oil crisis millionaires from everyone else. They focused less on fear itself and more on what fear could not stop. People still needed fuel, still needed electricity, still needed food distribution, still needed transportation. The systems supporting those necessities became the safest and most profitable investments on Earth. Another important truth emerged during the later years of the crisis. The richest investors were often emotionally detached from headlines. That sounds cold, but it matters enormously. Most people consume crisis emotionally. They absorb fear constantly through media, social platforms, and public anxiety. Their financial decisions become reactive because uncertainty feels personal. Professional investors think structurally. They ask, what systems break? What systems strengthen? Where does capital flow under pressure? That structural thinking creates clarity during chaos. One commodity trader explained it with a powerful analogy. The public sees fires. Millionaires study where the water must go. That perfectly captured the psychology behind crisis wealth. Every disruption creates pressure. Pressure creates response. Response creates spending, and spending creates fortunes for those positioned correctly beforehand. The oil crisis also revealed another uncomfortable reality about modern capitalism. The world increasingly rewards prediction more than production. Some of the largest fortunes during the crisis came not from building physical businesses, but from anticipating where instability would move next. Energy volatility, supply chain stress, government spending, consumer panic. The ability to predict pressure points became one of the most valuable skills in finance. Artificial intelligence accelerated this trend dramatically. Advanced trading systems analyze geopolitical developments, social sentiment, energy flows, and infrastructure vulnerabilities in real time. Fear became measurable, and measurable fear became tradable. That may have been the strangest evolution of all. Human anxiety itself became an economic asset class. One economist described it during a televised debate as the monetization of instability. A harsh phrase, but accurate. And the investors who accepted this reality early accumulated extraordinary power. Yet despite all the complexity, all the technology, and all the financial engineering, the final lesson of the oil crisis remains surprisingly ancient. Civilizations survive on essentials, not trends, not hype, not speculation. Essentials. That truth reshaped America permanently. Energy independence became a national obsession. Domestic manufacturing returned aggressively. Infrastructure resilience dominated political debate. Preparedness culture entered mainstream life. The illusion of permanent stability disappeared forever. And in that new world, the greatest fortunes belonged to people who understood systems deeply enough to predict where fear would redirect money. Not because they controlled history, because they understood dependency. Dependency on fuel, dependency on infrastructure, dependency on uninterrupted movement. Once those dependencies became visible, the path to wealth became brutally clear. Own what society cannot function without. Protect what governments cannot afford to lose. Invest where panic eventually forces money to flow. That was the blueprint behind every major oil crisis fortune. And perhaps the final irony of all this was simple. The world spent decades believing technology had made civilization stronger than ever. Then one geopolitical conflict reminded everyone that modern life still depends on remarkably fragile systems. Oil moved the trucks moved the food, infrastructure moved the economy, and fear moved the money. That was the final secret of the oil crisis millionaires. They understood earlier than everyone else that in times of instability, wealth no longer belongs to whoever entertains the world. It belongs to whoever keeps the world functioning while everyone else panics.